Recording this video Monday 6th of May 2013. I hope you had a good weekend. Well, Monday's always a good day for me because I feel as if I get the day off. The European markets don't open till 6 p.m. here, Sydney time, and the US markets don't open till 11:30 p.m. at night. So I get kind of the day to think my thoughts. And I've been meaning to do a video on the Aussie dollar for a while. It's kind of been in the financial media quite a bit over the last month, particularly what the Aussie dollar is going to do, what the Australian economy is going to do, and so I thought I'd kind of put up my 2 cents worth. And it's a little bit prescient. Tomorrow we have an announcement from the Reserve Bank of Australia, the RBA. The money is on them cutting rates by 0.25%. We're kind of at record lows at 3% at the moment in terms of official interest rates, but that's a ways above what is happening in Europe, the US, and Japan. So there's a potential quarter point cut tomorrow, and then the money's on another quarter point cut by the end of the year because of the weakness of the Aussie economy. But let's have a look at this. So is the Aussie dollar going to crash? And I'm going to look at this in terms of first kind of the qualitative argument and then the quantitative or the more technical kind of argument to this. So first of all, just some of the media references. The most outlandish one, the one that kind of grabbed my attention when I saw it was this one. Business Insider picked this story up from the NBMG group, which I must admit I've never heard of before I saw this news release. Apparently they're an advisory group out of Thailand and kind of has spread throughout Asia. But anyway, they came out saying shorting the Aussie dollar is the trade of the century. So we'll see. They're kind of forecasting a crash in the Aussie dollar. Then we've got kind of a more measured approach. Stefan Molyneux from Free Domain Radio. I don't know if anybody kind of follows him, but he's a very smart guy. Not an economist and not really a financial kind of commentator much, but he does commentate on the state of world economies, I suppose. And he had a whole piece a few weeks ago on what he called the fall of Australia, which was a piece basically talking about the socialist turn that effectively we've taken in Australia with our Labor government in the last 4 years or so. So we had the Liberal government, which is effectively a Conservative or Republican government, lose office in I think '07, and then since then we've had a couple of different prime ministers who've been Labor. So they've been kind of, English people will understand the term Labor. In the States that's more a Democrat. So we've had kind of Democrats in charge for the last several years since '07. It's resulted in a very large kind of blowout in terms of government spending, government employees, and so on. And Stefan Molyneux did a big piece on that growth, and therefore, Australia will go to the dogs because we've taken this just bad turn. And then on the other side of the equation we've got Simon Black, which is a pseudonym, Sovereign Man, and I like the Sovereign Man stuff. This one, totally different perspective, saying that Australia is actually a safe haven in terms of capitals, international capital flows. He was in Australia recently and wrote a piece, why this place is becoming the new Switzerland. He's talking about Australia, which I actually have a strong kind of association with, having lived as a kid in Switzerland, but also I associate with the story because I actually think that Australia is in some respects becoming the new Switzerland. But let's keep going through the story. In terms of cons, this is what the negative kind of the side of the ledger kind of says in terms of Australia and where we're going. First of all, Australia's economy is made up of 2 components, the mining sector and the housing sector. And everything else is pretty minor. I mean, we manufacture a little bit, but it's kind of in massive decline and has been for, basically since the 50s. And so the 2 big kind of engines of growth are the mining sector and the housing sector. Don't forget, kind of housing sector is not just the turnover of houses. There's a huge, I've said this a few times, there's a huge correlation between people buying houses and buying other stuff. As soon as you buy a house, you also buy all the furnishings for that, new furnishings for that house, new refrigerators. There's also a huge propensity to buy new cars when you buy a new house, and also you tend to be having kids when you're kind of changing houses or moving houses, whatever it might be. And so when you're doing things with property, you tend to be spending a lot of money in general in your life. And so housing is not just the turnover in housing, it's the kind of the whole multiplier effect, the economic kind of combination of all of those things together. So you put those 2 sides together, and so first of all they say, well, China is slowing and the mining boom in Australia therefore will kind of peter out, and we've had a huge mining boom. It's been in 2 or 3 legs basically, probably 3 or 4 legs since the 70s, when you go back to kind of the mining boom in the 70s, but latterly in the last 10 years basically there were 2 legs to the mining boom. The second one is to say that the housing market has peaked, and just like everywhere else in the world, housing kind of eventually kind of comes down from elevated levels. We've had a huge housing boom in Australia, with housing prices at record highs, on all kinds of metrics, price to income, yield, you name it. Australian houses are extremely expensive. Whenever we travel to Europe, we're kind of looking around at kind of regional towns in France and looking at the prices and thinking, what a bargain. Then when we're staying in Hawaii, with the crash in property prices in the US effectively halving. They certainly halved in Hawaii, over the last since '08, and we're looking at the prices thinking they're a bargain compared to Australia. So that's definitely true in terms of valuations and the price of property, and so at some point it'll come off. How it comes off, whether it crashes or just goes nowhere for 10 years, is kind of the question. But people argue on the negative side that the housing boom has peaked and will come down. Housing approvals have been very weak, and so that whole housing sector is going to come off. And then in general, the economy is slowing and unemployment is rising. We've had very weak retail numbers in Australia for literally since the financial crisis in '08. I don't think we really ever printed much of a positive number on the retail side of things, and unemployment just ticked up. The last number was up 0.2% to I think 5.6% unemployment rate here. Again, better than obviously Europe and the US, because we've had a little bit more robust economy through the financial crisis. We didn't actually hit the recession. We didn't go negative GDP in Australia, but the unemployment rate has started to tick up. And then lastly, the net result of all of this is we have consumers left with extremely high mortgage debt. Not particularly credit card debt, not like the US, I'd say, but and certainly not in terms of education debt. But the mortgage debt in Australia is very, very high on a per capita, per household kind of level. So on the negative side, people point to these points and say, look, the economy is going to come to a nasty end and weaken quite considerably. And effectively, an FX, a forex rate, a currency, is a measure of the strength of that economy. It is a bet on whether that economy is a good bet or not. And so, if things are going to go south in Australia, the Aussie dollar is going to go south. On the other side of things, and less popularized in terms of the responses to these things. So first of all, let's talk about China. Is China going to have a hard landing or a soft landing? The Chinese urbanization rate is sitting at about 53% at the moment, and is forecast to go to 70% in the next 20 years. It's gone from 25% to 53% in the last 20 years. So you could argue that train has still got a long way to run. There'll be kind of booms and busts kind of along the way as you kind of overbuild infrastructure and overcapitalize, and kind of you come back to trend, but the trend is still up in China. And then the mining boom is not just focused in China, it's also focused at India, and India is in many ways a more attractive market in terms of growth potential and population growth and urbanization and growing middle class. And so the mining boom is kind of focused on those export markets, both of those markets. Then the next one is in terms of the housing market. Our housing market is very pricey, but we didn't overbuild. It's not like the US, where there are 1 million empty homes in the US, and in Spain there's 1 million empty homes in Spain. I mean, in Spain they went nuts building properties. We drove around there three years ago, I think, in the south of Spain, and there are empty apartment buildings and buildings that are not finished, hardly even started. There are kind of empty car park lots that were supposed to be kind of small housing developments. We did not do that in Australia. Australia, the vacancy rates are almost at record lows. In the major cities, they're sitting at about 1.3, 1.5%. The approvals have actually been coming down, so we're not building enough for our population. And the other factor that we have in Australia is we have quite a lot of overseas buyers. So we've got a lot of expats, Australian expats who are kind of overseas, and they tend to park their money. They might be in Hong Kong, Singapore, London, New York to some extent, kind of living and working, making major money, and then they always think about retiring back to Australia, and they come back and buy big, spend their bonus money in Australia buying properties, and it tends to support at least the high end of the property market here in Australia. And then we've also got those kind of capital flows coming from the Asian markets, from Hong Kong, Singapore, and China, with those kind of Chinese type money kind of coming in, trying to find a home. So we're kind of the Australian property market is supported by low vacancy rates and also the kind of marginal buying from overseas buyers. Then our population growth has also been growing at about 1.5% a year. When I first came in Australia 20 years ago, population was 17 million. And we just had numbers come out say that we've gone to 23 million in the last 20 years, which is about a 1.5% population growth a year. And it's roughly split 50-50 between births and immigration. So net inward immigration, a lot of people kind of basically escaping the stagnant economies in Europe, and particularly the UK. To some extent Asia kind of coming in to Australia and India. We have quite a lot of large net inward immigration from India. In terms of the media gets all upset about boat people coming from Afghanistan, Iran, Iraq, and so on. But in terms of numbers, they're insignificant compared to the more legitimate type net immigration. So our population is growing. And we've also got room to move on interest rates. They're sitting, the official rates are sitting at 3% at the moment. Could be coming down to 2.5% in the next several months. And still at 2.5%. There's still 2.5% of movement, if you like, if you went to kind of the Japanese extreme. And that would support economic growth. It was interesting when Australia went through the global financial crisis that we went through a TARP-like program here where the government kind of went into debt and gave away money to families, and there were checks in the mail, all that kind of stuff. It had a minor impact. People used the money luckily to pay off credit cards. They didn't go out and spend, which was what the government's plan was in order to help particularly the retail sector. But the biggest impact, so although the government went into debt to do that, it had a very small effect on kind of growth. The one thing that made a huge impact to the Australian economy kind of coming through that GFC was the reduction in interest rates. I think we were sitting up at 7.25% in terms of official rates at the time, and they lowered those very quickly over the course of about 9 months or so down to 3%. And because everybody has huge mortgage debt and they're all variable rates, we don't use fixed rates in Australia, a very minor part of the market. The maximum you can fix is out to I think 5 years, and most everybody is on a variable rate mortgage. So as soon as those mortgage rates, the official rate coming down from plus 7% down to 3%, you can think that the banks are making a margin of 1.5% to 2% on that, but they brought them down in the same kind of speed and magnitude. That was the thing that had the biggest impact. All of a sudden, people had money in their pockets because their mortgage was smaller. So whatever they were kind of losing in terms of being unemployed or less hours being worked or whatever it might be, was made up for in net by a reduction in their mortgage costs. So, and then lastly, the banks are sound and we have low government debt. I've talked about the low government debt story before. I think we're sitting at about just under 30% debt to GDP, government debt to GDP. And although the banks are sitting on a lot of mortgage debt, here we don't have. Now I can never remember whether they're recourse or non-recourse loans, but jingle mail is a thing you will not get in Australia. If I can't make my mortgage, that is my problem, and I have to make it up. I can't just send my keys into the bank and all of a sudden, the expensive house that I bought is the bank's problem. We're not like that. We're more like the UK in terms of the mortgages that we have. I have to pay it unless I go bankrupt. So the banks, to some extent, negative equity is a problem that the consumer has, the householder has, rather than the bank has. So the bank might have more elevated levels of distressed assets and payment on mortgages, but it won't be as extreme as, for example, the US market went through, because people do not walk away from their homes. And to some extent, we've not gone through the kind of crazy lending. We had a period in the 90s, 92, 93, where one of the banks went under, one of the major banks, Westbank here, went under, and Citibank also went under during that time as well, as an overseas bank. Both had to be recapitalized, and the banks to some extent learned a lesson from that correction, that property market correction, and so coming into the 2000s they were far more prudent and didn't go kind of as crazy as the American banks did. So we got relatively sound banks and low government debt. So there are the two arguments, pros and cons, and you can argue them either way. How forcefully you kind of feel that one side of the equation or the other. Just to reference where we are in terms of accumulated debt and taxes, and I've spoken to this in my taxation kind of video. Here's Australia here. Of all these countries, there's a relationship between the tax revenue that the government is collecting versus the accumulated debt, and we have countries that are in real problems like Greece and Japan and Greece here, where their accumulated debt has all of a sudden just got way out of control. They're not making enough tax revenue in order to pay this stuff off, and all of a sudden it's kind of reaching the wall. And we have countries that are also struggling to raise taxes in order to pay off accumulated debt. Italy's a good example. They've got kind of stagnant population growth, stagnant GDP growth. Their tax revenue is already sitting at 43 or so % of GDP, and their accumulated debt is over 100% of GDP. So they're in a real kind of problem. They've got to struggle forward. How do they do it? Do they do it through austerity, or do they do it through kind of stimulating the economy and trying to grow their way out of it? Then we've got these kind of high tax culture countries, Sweden, Denmark, Norway, Finland, and so on, where they haven't got out of control with their debt, but they're paying extremely high taxation rates as individuals. And then of this group of kind of flight to safety countries, here's Australia down here, with Hong Kong, New Zealand, Switzerland, where we have taxes are years ago taxes in Australia were considered high, but we've kind of lowered them over the years gradually, and everybody else has been raising taxes, and we've actually ended up now in a situation where our tax rates are just net kind of almost the same in terms of total tax take as the US. And coming from the UK, where the US was always viewed as a low tax country, that Australia has kind of reached those levels is quite a revelation, really. And in terms of accumulated government debt, I think we're sitting at about 30% at the moment. So we've kind of got this kind of flight to safety status because the government debt is low. We have economic opportunities because the taxation is low, and people, it's worth people's while going out and starting businesses and doing business because the tax is relatively low. So it's an attractive place to be from that perspective. And then because I do lean on this side of Australia turning into the new Switzerland, and don't email me if you live in Switzerland and tell me how crazy I am, but the Swiss have taken a turn for the worse, I have to tell you. They have their central bank intervention is now to the size that it's 100% of the Swiss GDP. What they have done in order to fix their Swiss franc with the euro is print money to the tune of 100% of the Swiss GDP, which is, I'm sorry, but that's just not fiscally sound. That's a crazy thing to do, and they went ahead and did it. They also, screwed up the privacy in terms of banking, Swiss banking. No one trusts the Swiss anymore. It's unfortunate. I don't think they changed the rules, but there were just some bad eggs, who went out and kind of whistleblow and sent lists around to the Germans, the US, and whatever it might be. So you can't be sure of your Swiss banker anymore, and that's a sad kind of state of affairs. So two of the kind of cornerstones of the Swiss economy, they shot themselves in the foot. So they're not who they used to be. And all I'm saying is that Australia is at the top of a lot of these benchmarks. Now, you'll find it very difficult to read this here, so I'll just pick up some of the points, and I'll link to this in the blurb that goes with this video. But I'm keeping a score, if you like, of where Australia sits in a whole bunch of different kind of metrics. And so, for example, Australia is currently 5th in the world for economic freedom, behind Hong Kong, Singapore, New Zealand, and Switzerland. So that's a nice group of countries to be part of. We're also 5th in terms of the least sovereign debt risk, again behind Norway, Sweden, Switzerland and Finland. Australia's current credit rating is AAA across all 4 credit agencies, and as you'll know, the US and the UK no longer kind of sit in that kind of group where they've got AAA across all the credit rating agencies. 4 of Australia's cities, I mean, we're not a big country and we don't have that many cities. Capital cities, I don't think there were kind of 5 major cities in Australia, but anyway, 4 of them sit in the top 10 most livable cities in the world, and those are Melbourne, which is number 1, and then Adelaide, Sydney and Perth, and they're numbers 6, 7 and 9, so a nice place to be. And then Australia just came out ranked first for personal rights, which includes kind of political rights, freedom of speech, freedom of assembly, private property rights and so on. Canada was second, Switzerland was third. So Australia does have these kind of benefits, and again, as I say, in the 70s, Australia was a little bit of a basket case, a bit of a banana kind of republic, banana economy, and we've kind of gradually moved. I say we, but I think you get the picture. Australia's kind of gradually moved up, kind of in terms of addressing those things, and a lot of the rest of the kind of developed world has actually gone backwards, unfortunately.